What's going on, everybody? It's Rensing Trades back with another episode, and today we're going to be talking about credit spreads. If you've never traded options before and you want to get some basics, I have a bunch of videos just off put options, call options, and various other videos. So I have a playlist for beginners who are trying to make their way into the option trading scene. So I'd start there if this is your first time you're hearing about trading options. But anyways, for my experienced option traders here, today we're going to be talking about credit spreads, both put credit spreads and call credit spreads, and why I would use them. So let's make this quick and jump into a chart here so I can show you an example of a put credit spread. So this chart right here is D.R. Horton. They build homes, and I'm in North Texas. I see these guys building homes like crazy, and I know that the chart is oversold. You can see that the reason why I'd be bullish on this chart is because the MACD is crossing to the upside, the RSI is oversold, and we're also sitting at the 200 EMA, which is that white line there. So there's kind of everything lining up that you would want to be bullish on D.R. Horton, or DHI is the ticker symbol. Therefore, you would do a put credit spread. A put credit spread is a strategy that is used whenever you are bullish on a specific stock. So let's go ahead and open up DHI on my Robinhood. As you can see, I already have it pulled up. It's at $119.58 a share. We'd open up the option chain. We'd click on sell put just like we usually would when we'd sell a put option. But instead of using money as collateral, we're going to use a long put as collateral, or buying a put as collateral. So let's look for something that's at about a 0.3 delta. That's going to be the 114. I usually use 0.3 deltas because it's like the best bang for the buck risk-reward ratio in my own personal opinion from past experiences. So the 114 strike is going to be what I would sell. Now you can see here the max loss on this position is $11,165. That's because this is $11,400 because, right, you multiply the strike times 100, which equals $11,400 minus the premium collected, which in this case would be $235. Now you'll say, well, that's a lot of money to use as collateral for one sold put. And you would be correct. And especially, if you have a multi-million-dollar portfolio, maybe this wouldn't be so bad because you have lots of money to sell puts on D.R. Horton. But for a guy like me that only has $100,000 in my portfolio, or just roughly about $100,000, selling one put option on this would make it to where I put over 10% of my portfolio into one short put. So instead of doing that, we will sell the 114 and we're going to buy something that has a lower strike. Now, in this case, we can do the 113, which makes it to where it's only a $1 difference between the 114 and the 113. So you can see here on the expected profit and loss chart, I have a defined loss of $75. Now, why is that? It's because I sold the 114 and because I'm buying the 113 with the same expiration date. The difference between these two in collateral would be $100. You can see that the collateral off of $11,400 and $11,300. So that difference is $100. But in this case, we could collect a credit of about $25. So we could collect $25 and the max loss would therefore be $75 because the difference between the collateral and the premium collected is $75. Well, you might be asking, then how do you win? Like, what's the goal? How do you win? When do you lose? Stuff like that. Well, let's look at the chart here. So you can see that above 114, you keep all the premium you collected. So as long as the DHI, or in this case it's DHI, by June 20th or on June 20th, the expiration date on the option is above the sold put, we keep all the premium. But if DHI drops below the bought put, then we reach our max loss. So if you adjust this to say the 110, instead of buying the 113, let's say we buy the 110, this would be a $400 collateral difference. So this would be $400 in collateral, but we could collect, this thing is saying $93 would be the midpoint on this. So we're collecting more credit, but there's more of a difference between the spread, therefore it's less risky. So the percentage that you're actually collecting is less. So in this scenario, we're collecting 93 for a max loss of 307. But if you go back to the 113, which we did initially, you can see that the percentage or the return on collateral is much higher because it's a much more risky play. So if you're more conservative, you can do the 110, make the spread larger. You can even do the 100. You can even do the 100 here. You can see that this would be $11,400 and $10,000, which would be a $1,400 credit spread. But you would only collect $203 to put up $1,200 in collateral. So it all depends on what your risk tolerance is. So that's a good example of a put credit spread. Now let's talk about call credit spreads. Call credit spreads isn't necessarily something that I always like to do because I feel like it's easier for me to enter into a stock thinking from a bullish perspective. Now, if you're a trader and you've been doing this for a while, maybe you see it differently. Maybe you can, be on the bearish side. But for the most part, the stocks that I'm looking at, I usually am looking for those stocks to go up and to the right, and I'm usually bullish on them. But if you, as a trader, also trade to the bearish side and go short, then a call credit spread is going to be a great tool for you to put into the bag. So let's go ahead and take a look at an example of a call credit spread. So in this example here, I have pulled up Rivian. This is the electric car company. I'm sure you've heard of them, and if you haven't heard of them, I'm sure you'll hear of them soon. I have 1,000 shares of Rivian, and I'm very bullish on the stock for the long term, but it did just break out of a wedge. It has a massive move to the upside, so therefore it probably is a little bit overbought right now. So this could be a good contender for a call credit spread because call credit spreads is a bearish play. So if we look at the chart here, we can see that Rivian, like I just explained, has broken out of a wedge to the upside. The RSI is a little overbought. The MACD is crossed to the upside. Some really strong bullish bars there. So let's just say that we don't think Rivian's going to go above 118 by the end of June. We can go ahead and open up Rivian here, go to their option chain, and go to June 20th, which is 30 days out, and we'll do the exact opposite as a put credit spread. So we will sell the call first at a lower strike. So we'll do the 18 call, and then let's buy the 19 call. So like in the other example with DR Horton, this is a $100 difference. $1,800 we're selling the call, and $1,900 for buying the call, collateral-wise. So it goes from you're basically having a max loss of $1,800 to now you have a defined loss of the difference between the two strikes minus the credit you've received. So in this case, we are putting up $100 of collateral, but collecting $18. Now, this play isn't necessarily the greatest risk to reward, but it's a great tool if you're looking to lower the amount of collateral being used or the buying power that you're using and actually collect a credit. Because in this case, you could either buy put options, but you're the one that's paying for it and you're also having theta work against you. Whereas with a call credit spread, you're collecting money from somebody and you have theta working with you. So it's kind of a play on, do you want to buy puts or do you want to sell call credit spreads? It's kind of like, two very similar bearish strategies, but there's multiple ways to attack this. So, if you thought that the 18-19 spread was a little too tight, you could do 18-20. You can see that you'll collect a little bit more money, but there's going to be a higher loss. So 18 and 20 is a $200 collateral, and in this case, you'd collect $30. So your max loss would be $170, and the max profit would be $30, because that's the difference between the two credits there. So hopefully this showed you how to sell put credit spreads and sell call credit spreads. And like I said earlier, I usually stick to the put credit spreads because it's easier for me to look at a chart and go, yeah, I'm bullish on that stock or I'm not. And most stocks that I deal with go up and to the right. But if you are a trader that trades both to the upside and the downside, put credit spreads and call credit spreads can be a great tool for you to use for the future. So I hope you guys enjoyed this episode. If you haven't already, make sure that you subscribe to my YouTube channel and also follow me on X. I post, constantly. I'm posting almost all my trades on there. So thanks so much for your guys' continued support, and I'll catch you on the next episode.